Thank you. So the markets have been going up and down. It's a little bit unsettling lately. Lots of headlines to kind of sift through. So we wanted to this chat and give everybody a chance to hear from Adam Turnquist,
Oh,
who's the
yeah.
Chief
I'll put the
Technical
camera on.
Strategist at LPL. And he's going to be giving us some of his insights, some information, some charts. Adam's going to join us, hopefully answer some questions for us, give us his perspective on some market conditions and answer some questions you all might have. So I don't know if Adam, if questions wait till the end, is that better for you?
All right, there we go. Unmuted. Yeah, probably we can kind of take them as we go. Otherwise, save them for the end. I find that a lot of times when the questions come in, we'll get to them usually throughout the slide presentation. But if something is topical, feel free to ask. I'm pretty open.
Okay, great. So thank you, Adam, for joining us. We'll let you take it away.
All right, thanks everyone for joining today. Appreciate the opportunity to get in front of our clients here, especially in light of what's going on. It's been a crazy few days, to say the least, in the market, and a lot of wild swings. I got some fun stats for you to kick off today's call. For the S&P 500, you had 98% of the index trade higher today. We had a massive rally. It was actually the ninth best trading day for the index going back almost 100 years. The range that we've experienced from the high to the low, that was the sixth largest range going back to the 80s. The VIX, which is called the fear gauge, is a measure of volatility, largest single day drop. Some of these moves were, for anyone that follows statistics, 9 sigma type moves, so 9 standard deviations, which are pretty much unheard of. The stat there, they occur every 13.7 billion years. That's about the same age as the universe. So we had some absolutely historic moves here in terms of price action today. Of course, at the center of all of that, I think we know what's driving the price action and that volatility is tariffs. So if we flash back to Liberation Day, I'm not sure how many people out there celebrated it, but the market did not. And it's been stuck in this hangover period up until really today, coming out of Liberation Day. Of course, that's when President Trump and the White House announced their tariffs really across the board. There was a 10% universal tariff, and then each country had reciprocal tariffs, excluding Canada and Mexico. Here's some of the longer term views of the average tariff rate. So this is what we charge on imports on average over the last 100+ years here. You can see relatively low for most of the last 40, 50 years, kind of in the low single digits. For example, last year, I think our average tariff rate was around 2.4%. The expectations going into this, we knew the White House was going to raise tariffs, right? The Wall Street kind of consensus view, more or less, was maybe 10 to 15% on the high end. So that was kind of the base case. What we witnessed is a much larger tariff rate. On average, it was expected to jump anywhere here from 20%, according to some estimates, as high as 27%. So what does that mean for the economy? Well, when you have higher tariff rates, it means you have to take down your growth expectations. And that's what we witnessed from Wall Street. We had several recession calls right after the news. You also have to bring down earnings. If you think about if you're importing products and you're a company in the S&P 500, you either pass on the added costs from the tariffs to your consumer. Consumers don't like that, or you eat it in the form of margin. So you're not making as less, earnings come down. And then, of course, you just have slower global growth on the back of that as well. So you have earnings coming down, growth coming down. And then, of course, the other factor is inflation, expectations moving higher. It's basically a step function in terms of that price move higher. So you also had inflation metrics moving higher or forecasts. That's not a good combination for equity markets, as we learned. And the fallout was pretty severe. Of course, we moved right into bear market territory. The headlines extremely bearish, of course, when you think about the jump in tariff rates. But I think you have to put it in a little bit of context in terms of financial stress in the market, and that's what we're doing here, just as a quantifier to some of the headlines and how stressful is this actually for the economy. And this is using Office of Financial Research data. They basically take a market-based snapshot of financial stress. They use 33 different indicators looking at whether it's treasury market spreads, volatility. I'm not going to go through all 33, but I think you get the point. As this moves higher, that means there's more financial stress in the market. Obviously, when it's moving lower, vice versa. The blue line is US financial stress, this index. 0 is the average stress level. And in light of the recent tariff news, we're of course moving higher and at a pretty sharp rate, but we're not even back to, for example, the August 2024 lows. I'm not sure how many of you are watching the market then. We had this event called the yen carry trade unwind. The market sold off pretty severe into those August lows. You could see the financial stress index getting back to about 0. The bear market that we had in 2022, you can see some of these peaks in that financial stress. So I think context is key here. We've been very accustomed to low volatility, low financial stress. So this shock that we witnessed through the tariff announcements probably feels a little bit more painful than it is, at least on the financial stress level. Of course, when you look at your portfolios and they're down significantly, it is certainly painful. But we do have some good news as well. There are some silver linings to the tariff headlines. One, they did carve out USMCA trade deals. So with trying to get my highlighter here, with Mexico and China, they did not get, or excuse me, Mexico and Canada.
Adam, real quick, just to interrupt,
Yep.
I think you might need to share. I think we lost your share.
Oh, uh-oh. Let me jump
Sorry
back
about
up there.
that.
Did you get the last, hopefully you got the last screen.
I can see it.
There we go. For some
Does
reason it's not.
everybody,
Do you see that now?
can everybody give a thumbs up that can see it or,
I
yeah.
see it
You see it? Okay,
sharing on my
perfect.
end.
All right, thanks, Adam. Sorry about
Got it?
that.
Okay, cool. If you didn't see the last chart, I hope you did, but this is that financial stress index. So something we're watching to really calibrate how bad is this in relation to other events. And the one-liner here, the change is moving higher, but on relative terms, it's nowhere near the financial stress that we witnessed and some of these other major events. As I mentioned, Mexico and Canada, they did get that carve out for USMCA, so they did not get the additional or reciprocal tariffs. China is really the big problem here when it comes to trade. We've witnessed that throughout the trading day. Last time I looked, we were at 104%. They keep going up. China retaliated. The White House added more tariffs. I forgot where they ended up today. I just did see another headline on tariffs, but it's very fluid. And the likelihood of those tariff rates sticking for very long is pretty low. So we think there'll be a negotiation. I heard President Trump say that today, that China will make a deal. More to come on that. Of course, we did get the announcement today that the White House is suspending or delaying the tariff implementation for the countries that did not retaliate for 90 days. We got a glimpse of that on some apparently fake news yesterday, and that was a big catalyst for this massive rally in equity markets today, that delay. And some people are calling it what's known as the Trump put. So a put option is kind of your hedge of downside risk in the market. And I think with a lot of the recessionary or calls for a recession, near bear market territory, maybe we found that Trump put with this latest lower on the market on Friday. And as we look ahead now, we've finally kind of ripped the Band-Aid off of the tariff announcement on Liberation Day. That sticker shock was a big catalyst again of why equity markets sold off. But now the narrative starts to change here from the actual tariff rate to negotiation. And that's what I think is helping equity markets find a footing and find a bottom here. And then we think of the sequencing problem for US equity markets, and we're fortunately moving away from the spinach. That's the tariffs that we're talking about right now. If I have a 3-year-old and I always try to get it to eat his vegetables, I usually put those on the plate before anything else. And that's usually the face I get from him. This is not my child. I actually used AI in about 35 seconds to generate these images. And that's the face the market made when they saw those tariff news. Now, fortunately, we're moving to the better part of the plate with the candy, and that is the likelihood we're going to get something done on a tax bill to extend the tax cuts from 2017. We could see lower corporate taxes. We could see lower income taxes. A lot to be determined there, but certainly more pro-growth type policies are coming out, not to mention deregulation as well. So there are some sweetness in the back half of this year, we'll call it, that can keep supporting equity markets. A couple of key points on just what's going on in the market from a tariff perspective. Preserving that carve out for USMCA, again, that's the exemption for Mexico and Canada. We think that's key when you think about nearly 30% of our imports come from those two countries. Smaller companies, if these tariffs stay higher and for longer, could underperform, just given they don't have a lot of resources in terms of their financial situation, their logistics. They don't have the extensive supply chains. They cannot inventory things as long as some of these other big companies. So a potential loser out of this in the US equity markets could be those smaller cap stocks. And we have to put things in context as well. There was rising recession risk before all the tariff news. We are in an economy that is slowing, but still growing. We're not stopping here, and our GDP estimates have come down, but we're not calling for, or at least our base case is not for a recession. Turning to the charts, a couple other, we'll call it silver linings of the sell-off. We came into the year extremely overvalued. We use what's called a price to earnings multiple. So taking the S&P, dividing it by the earnings, and you can get an estimate of what you're paying for those earnings. And that's on the left here. And you can see as we came into the year, trading at 22 to 23 times earnings. The average over the last 10 years is about 18. So as this moves higher, that means the market's becoming overvalued. And it's sometimes hard to justify these high valuations if you don't have a rosy growth outlook. And of course, as that deteriorated, we've reset valuations back to the long-term average. So stocks from a valuation perspective look much more attractive than they did only a few weeks ago. One of the other sectors that's really important to think about is the technology sector. That represents about 30% of the S&P 500. The valuations there were extremely high relative to history. Those have now reset back to, we'll call it, their longer term average. So for new money coming into the market and concerns about valuations, those are largely gone now. And one less thing to worry about when we start looking at the multiples here. Earnings, of course, we're going to hear from the big banks on Friday. We've already heard some comments from JP Morgan CEO Jamie Dimon. He obviously did not like the tariffs and made that very clear. But earnings are holding up relatively well, and that's on this blue line here. That's S&P earnings for 2025. Normally, they get cut about 4% around the first quarter, and we've already experienced that. There's probably some more downside to go on earnings. So you'll probably hear news about earnings getting cut as we get through earnings season. I think there's probably, the market did a pretty good job of discounting that news on this 20% drop that we witnessed. You can see that here on the S&P 500. I'm guessing there's or maybe there's a few people that watch charts here. I'm not going to go through all the nuances of technical analysis, but when the market starts trading more on emotion and less on fundamentals, we often turn to the charts to help us identify where you could see a capitulation point. And this chart's from, I believe, on Monday morning, early Monday morning. So I didn't get it updated before I sent this off to compliance, but we've had a big fall from grace here. We had a record high mid-February, and basically we're in free fall mode all the way down to bear market territory. So we did get right down to some key support levels that we watched technically for signs of a capitulation. Interestingly enough, we were only 15 points away from that support level on the drop on Friday. So there's a good layer of support here below the market, right around, we'll just call it 4,800 on the S&P 500. I'm highlighting one of those support levels there. And we're also in a longer term uptrend. And you can see that this goes all the way back to the pandemic lows. Actually, I didn't zoom out that far on the chart. We're still trending higher on the market. We were very overbought, and we're now correcting back to that long-term trend. Internally, we look at all the stocks within the S&P 500 and we assess how oversold are those stocks? What was the rate of change in terms of their selling pressure? And we use momentum oscillators to really assess how the degree of oversold conditions. And I'm not going to get too far into the indicators, but historically, washed out levels is probably an understatement. These are type of readings that we get on these indicators that haven't been recorded since the pandemic lows of March 2020. This bottom panel, for example, that's called the relative strength index. When that's below 30, that's considered oversold. And we're at 23. We got down to, I think, 21. Those readings are extremely rare and kind of in the 99th percentile type levels. And again, you typically see those near market bottoms. Another metric we look at is just what we call breadth, or the internals of the market. We're measuring how many stocks are above different moving averages, and we use moving averages just to really identify trends. So for example, on this top panel, this is the percentage of S&P stocks above their 20-day moving average. So what's the average for the last 20 days? Is the stock above that level or below it? Consider that a short-term trend. And most of the time it looks pretty noisy, but this really does work well at extremes, as we've had in the last few sessions here. And what you'll notice when the market is extremely oversold and starts to form a bottom, you get a reading on this indicator of 10% or less. And you can go back throughout history and look at every market bottom, whether it's a correction or a bear market, and you're going to see that indicator flashing below 10. Same thing when we look a bit longer term on the bottom panel, that's the percentage of stocks above their 200-day moving average. So again, what's the average price over the last 200 days? Is the current price above that or below it? And that's just a measure of the longer term trend. So you want to see stocks obviously above that, suggesting they're in an uptrend. For the S&P 500, we haven't really seen that this year. We've been deteriorating in terms of the internals here. And we actually got a washed out reading on this indicator. So you have your short-term indicators flashing oversold, your longer-term indicators flashing oversold. And now when you look at price action today, we're starting to see repair to the technical damage. And that's typically kind of the last thing you're looking for. You're looking for support, you're looking for those washed out oversold conditions. And then on the upside, you're looking for an expansion in market breadth and some repair to technical damage. That's exactly what we witnessed in today's price action. So good signs here for the equity market. Of course, we look at sentiment gauges as well. Usually, I think sentiment's best used as more of a contrarian indicator. So when everyone is fearful, you should be greedy. That's not my line. It's a Warren Buffett line. And we were certainly fearful. And one way we measure that is called the CBOE, or Chicago Board of Exchange Volatility Index. And this is just what the market's expecting the S&P to do over the next 30 trading days. So when it's moving higher, that means you should expect higher volatility. This is usually signs of fear. You can use this to hedge downside risk. So you'll see this indicator spike materially higher during major signs of panic or fear over panic in the market. And we went all the way to 60 on Monday morning. We got close to that earlier today, and then sold off a lot on the VIX. Again, the largest drop on the VIX on record. And that's peak fear in the market. And that typically overlaps with a market low. I'm not going to get into the VIX futures curve, but we did move here. This is another signal that we look at. It's just called backwardation. That's another one that triggered in terms of identifying that peak fear in the market. Same thing on what we call the put call ratio. So all of this suggests we have hit peak panic levels in the market. And simple story is that's where you are close, if not on the market lows. You can back test this as well. A lot of data on this chart, but we've actually looked at every intraday high of the VIX. So we went through again on this chart, looked at all these big peaks all the way back to 1992 to understand, okay, how high does the VIX need to go for it to be meaningful? And how high is panic? Can we quantify that? And we do that using decile ranking. So on the far left, this is the top 10% of all VIX intraday highs going back to 1992. And then we look at how do the S&P 500 perform over the next 1 month, 3 months, 6 months, and then 12 months. And then we compare that to history. Are these above average type returns? And this is really the qualifier here. When you get a VIX above 30.1, it's a little technical there, but call it above 30, that's when panic is taking place. And that's when you typically see above average type returns for the broader market. You can see all of these other decile groups are kind of more or less in the average range. You can see here's the average for the S&P across those time frames. So again, long story short, we've hit that peak. These are significant values, not only from an absolute basis, but they're meaningful when you backtest it. We've been cautious about market timing. I think, I'm often asked, okay, are we low? Are we at the market bottom here? And I always like to make the comment on that. It depends on what game you're playing and what you're using to find it. If you're using horseshoes, you need a little bit of luck and you can be close enough. And I think that's the call here for the S&P 500. If you're looking for precision in a bullseye playing darts, you're going to be let down. And I think that's key to trying to identify a market bottom. It's an art, not a science, and you have to use a horseshoe, not a dart. And I would argue the lows, at least technically here, were likely set over the last few trading days. It doesn't mean we'll immediately move higher. We should expect a 10% up day on the NASDAQ or anything like that. But I think there's some comfort now in that 4,800, 4,820 level that's going to hold. If you're market timing and moving money in and out of the market, trying to time those lows, here's some examples of why not to do that. Of course, we think you should be invested, fully invested, and you can change that investment level, whether you go overweight or underweight equities, but we think you should always have some equity exposure for the most part, of course, client specific. But here's what happens if you miss we'll use the 3 best trading days of going back to 1990, and your average annualized performance for the S&P 500. You'd be up 0.4% if you missed those 3 best trading days. Now, if you just bought the S&P 500, held it since 1990, you'd have an average annualized gain of 9.8%. So if you just miss those 3 best days, that is the difference in returns and that cost of market timing. And the problem for this, I think for a lot of people, is when you get these sell-offs, there's a lot of panic. And that's exactly what we've been advising our clients not to do. You have to think longer term here if you have that flexibility, because a lot of times, at least history has shown that the best trading days happen in moments like this. And I ran an analysis earlier today. If you look at the 100 best trading days in the S&P 500 going back to 1950, the average drawdown at that time was about 27%. So in a bear market, the 100 best trading days, almost always in a bear market, except for 2 were actually at record highs. So 98 out of 100 times you're in a pretty significant drawdown. Very rare do you get a major up day when you're near record high territory. So again, stay invested, don't panic is the key message there. I'm going to skip ahead here because I think I hit on sentiment already. We know it was extremely bearish. One other thing that we've been watching for is what we call institutional money or hedge funds to come back into this market. If you look at their positioning, and we're going to use a few different indicators here, these are called systematics. These are trend following type hedge funds. Just think of institutional money and order flow here, and that's in red. This is their assets under management and how much they're holding in US equities over the last 6 months. This red line that I'm highlighting here, they have been selling and reducing exposure to US equity markets. And there's various reasons why. It could be volatility or the trend break. This aqua line, we'll call it, these are long short hedge funds, so they're taking long and short positions, as the name implies. They've been pretty underweight. They started to increase their equity exposure, but there hasn't been much institutional participation in Q1. We're watching for this to bounce here on this rally if it continues, of course. But in yellow, and this is really where it gets interesting, this is retail investors. So people that are kind of day trading at home, they're not using an advisor, maybe leverage positioning. This is in yellow. And you can see they did not care that the market went lower in March. They did not care that the market traded lower even last week. They're buying equities on Friday and on Monday, and all of the volatility, they continued to add to their positions. On Wall Street, there's just this assumption that smart money, it's called institutional or that hedge fund money, often sells to retail at market tops. I push back a little bit against that. I think times have maybe changed with the amount of information and the technology we have now, because retail bought the dip, that August low, when we talked about that yen carry trade unwind, as institutions were selling, actually. They did a great job during that period. If you go back to the pandemic, retail was probably one of the first asset or the first people to jump into the equity market in March in a sizable way. So they've done some pretty good jobs of picking off market lows and staying with it. So, but it would be nice to see institutional demand come back into the market if this upside continues. We're going to jump ahead quickly on the bond market. I'm sure many of you have some type of fixed income in your portfolio. There's a lot of volatility in the bond market as well. On Monday morning, the 10-year Treasury yield, for example, when we had a lot of recession fear coming off the weekend because there was no sign of any trade war negotiations making any progress, the 10-year Treasury yield, which is a pretty big proxy that we follow obviously very closely, went from well above 4% down to 3.85%. Now, I bought a house about 2 years ago. Of course, I was not lucky enough to get those 3% 30-year mortgage rates at the time, and that's what we had on our previous mortgage. But I ran upstairs and I told my wife, hey, we can finally refi our mortgage. I think we're finally at that level. Came back downstairs, and in about 20 minutes, that 385 on the 10-year was now about 415. It completely reversed. So there is a massive amount of volatility right now in yields. When you look at credit, and that's often where cracks first start to emerge if we're thinking about a recession, we've had credit markets expanding, and these are what we call credit spreads. So as these are moving higher, these spreads, these are investment grade and high yield spreads, that means there's a higher probability of default risk. Now, that might sound scary, especially when you look on the left side here, this surge in credit spreads. But again, you have to put things into context from where we are now to some of these other periods where we actually had a recession or a bear market. And if you take this chart on the left and you move it to, hopefully you can see my highlighter, that's where we're at on a longer term basis. To give you some context here, we're nowhere near bear market spreads. We're nowhere near the pandemic type of spreads. These are blowout type of credit spreads. So we haven't had a credit event in the market. There's a lot of concerns. Maybe this will lead to a recession and credit spreads. We'll start seeing some defaults. We're not seeing, I don't know if you could even call it a yellow flag, certainly not a red flag in terms of caution right now in credit markets. Here's a look at just the 10-year Treasury yield. I don't think I had the intraday moves here, but this has been bouncing all over the place. Today was another example. Yesterday was another example. I'm actually just checking my screen to see where we closed. Today, I think we were at 433 on the 10-year. So we've basically moved around about 50 basis points in a matter of days. That is not normal for the 10-year Treasury yield. A lot of this price action is not normal on the 10-year Treasury yield. We think the 10-year will land somewhere in between, call it 425 and 375 by year end. So more consolidation, if anything. Part of the rationale for that call, again, we think they'll be slowing but not stopping growth. That tends to put a lid on longer duration yields. We have to talk about the Fed. Their expectation, is that we're going to continue cutting rates, maybe 3 cuts this year. That has a gravitational pull on yields lower. Inflation coming down as well. So that should support those rate cuts and support kind of this range-bound market. And I think you have to be careful what you wish for, especially me, as much as I want that refied mortgage. If we're talking about a material drop in the 10-year Treasury yield, we're also going to have a recession in that same conversation, because that would be the market pricing in much lower growth. So I think 375 and 4.25, somewhere in that range, is going to be a great spot for equity markets. And we're in that range now. So hopefully this will continue. I can jump and talk about the basis trade. That's probably too much Treasury market detail. There's some concern about some dysfunction in the credit market. called a basis trade. I'll just say that it's something we're monitoring, but not something that keeps us up at night. Quickly, just on our LPL research team, before I jump into questions, just to highlight a few things. Our motto is our experts are your experts. So we're trying to help our advisors help you each and every day. And through that, we have a pretty deep bench within LPL research. You can see within our LPL models, we manage about 83 billion of LPLs. I don't even know where the total assets are for the entire company, but in the closer to 2 trillion. So we manage a lot of models on different platforms within research. And we do that through our Strategic and Tactical Asset Allocation Committee. We call it STAC, which is much easier to say. And this is comprised of different subject matter experts. So for example, we have Mark Zabicki, our CIO, he leads this. I'm fortunate to be on this committee as well. So I provide technical insights and macro strategy. We have a range of different strategists here. We have our equity strategist, our fixed income strategist, of course, our chief economist. And we sit around every Tuesday for an hour and a half and debate our asset allocation strategy from a strategic longer term view to a tactical shorter term view. And where are we right? Where are we wrong? What changes do we want to make? And I think the best way to explain this is kind of a recent example. This was 2 weeks ago, maybe 3 weeks ago, we had equity markets declining. We were wondering, of course, we're neutral US equities right now. So that means benchmark weight. So if you're talking about a 60-40 portfolio with 60% equities, that's where we think you should be in that weighting. And we've been looking at the market and the sell-off and trying to understand, should we go to an overweight? Should we buy the dip more or less? And we go around the horn. If anyone's ever seen that show on ESPN, we talk to our chief economist. What is the outlook on the economy? Does it make sense to go overweight equities right now? He chimes in on growth. Are we going to have a recession? What's the Fed going to do? How's the consumer holding up? Then we go to the our fundamental strategist, Jeff Bookbinder. He talks about earnings, valuations. How is corporate America holding up? We also talk about the macro backdrop. What's the ramifications from these tariffs? What are the fallout from the relationship with China? We talked about the fixed income market as well. I mentioned credit, how those credit spreads look, and is it worth moving to an overweight and potential an underweight in fixed income? Of course, it's a relative game. How do we implement anything if we do that? We have a team of portfolio strategists that not only tell us how to implement from a trading standpoint, but what assets we should be moving into. We have manager research, so we ensure that we're buying, if we're buying an investment product, if it's an ETF or a mutual fund, we're buying the best of breed in that asset class. We're not paying more than we need to for a fee on that. And then, of course, we look at the technicals. And during this example, again, this was a few weeks ago, we decided as a group, this is not the time to buy the dip. Of course, we're very active right now in discussions of potential changes and how we're looking at our asset allocations. So more to come on that, and we'll see if we do make any changes. But I would expect something relatively soon here in terms of whether it's a sector change in terms of our overweights or just our overall view on equity markets right now. So a lot of information there, a lot of charts. I hope some of you have some questions, and we can certainly take those now.
All right. Thank you, Adam. That was great information for you to share. So I think the way that we'll do this is if anybody can either raise their hand if they're on video, or if they can do the thumbs up if they have a question or a hand raised, and then we can kind of unmute as we go. Does that work for everybody? Let's see. Does anybody want to start us off with a question? And I wonder if I can actually. And I think I just changed it where everybody can actually unmute themselves. So if somebody wants to do that, they can. All right, I'll ask you a question since nobody's jumping in yet.
All right.
You mentioned earnings. The earnings season is starting. Do you think that we'll get a lot of forward guidance from the companies, or do you think that they'll kind of reserve that to see what happens with the pause?
It's a great question. And I think if you asked me this earlier today, I would say no. Probably going to see a lot of forward guidance pulled. I would almost say that's base case. I don't know if the 3-month pause on tariffs will be enough. We're still not getting to a hard concrete number on each country. And then, of course, China is such a wild card when you think about how much we import there. I would say, and this isn't a great answer, but it probably mixed guidance in terms of if it's going to be pulled or not. Baseline, though, is that guidance is going to be down. I'm not sure if today's news will completely resurrect confidence at the C-suite level from corporate America. It's been, following price action here lower. It's just that level of uncertainty. Still going to be high, I think, but we're past that peak policy uncertainty. Maybe that's enough to at least provide some maybe hedged guidance ahead.
Hedge is a good word, yeah. All right, has anybody got any questions? You can unmute yourself.
I'll actually ask one.
Okay.
So Adam, thanks for joining us. We have a morning call every morning with LPL that we listen in, and Adam contributes quite frequently. And while I'm listening, I tend to think of you as the chart wizard because there's just so much that you can pull and look at all the different factors. Do you feel like you mentioned confidence? Are you going to start? Is there a lot of tracking of confidence that you feel like you guys are going to be doing over the next couple of weeks?
I think so, because we know confidence is down materially, I'd say almost to historic standards, given the tariff uncertainty going into last week. So you're going to need to see some of that rebound, not only just investor confidence, right? We track several different measures there, but also we look at things like the small business optimism, some of these surveys that go out to small businesses across America. There's the ISM manufacturing and services data. You can read through some of the commentary there and get a better sense of what companies are dealing with, big and small. How is this impacting their hiring, their new orders, their plans for capital expenditures? And that's a big one too that we're going to be watching is not just the confidence itself in the overall economy, but capital expenditures. How much are companies going to spend on build outs, things like data centers and AI related spending? I think we'll probably get back to that story. I don't know if we'll get a lot of details quite yet on those CapEx numbers, but that was one of our catalysts for growth this year in terms of those capital expenditures. They're quite meaningful, and they've become increasingly meaningful with some of these big tech companies spending billions and millions of dollars on their overall capital expenditure plans.
Awesome. Thank you.
Did you unmute yourself? Do you have a question?
I do. And Adam, thanks so much. That was a great presentation, and it was also very reassuring. But playing the devil's advocate for a minute, it sounds like you don't anticipate that we are trending into a bear market. But of course, nobody, and please forgive me if I'm not explaining this correctly, but if we do trend into that bear market, what would you suggest at that point?
Well, we know that, I mean, our base case, again, not a bear market, not a recession, but as you mentioned, we don't have a crystal ball. I do have, though, the magic 8-ball. So I keep this on my desk, and actually an advisor gave me this because she asked a question on a call and I didn't have an answer. So she said, you need a magic 8-ball. But on the bear market, again, we've done, let's say we get back down and we start breaking some of those support levels. You have to put things in the context of how much more downside there is when you're talking about at that 20% starting point. Your typical bear market kind of maximum drawdown is kind of 25 to 35%. And bear markets, it's hard to use the word typical because there's context that's needed there. There's really no typical bear market, although the 2022 one was kind of your garden variety bear market. And then you have to look at from reward to risk. Do you want to sell stocks down 10 if we go another 5% downside, 10% downside if you're getting close to the low? Usually by the time you get to that 20% mark, you're already getting close to that low. And then I think it's just active management to what do you do? You're looking for areas of the market that are going to be more defensive. So areas like potentially utilities, consumer staples, healthcare, real estate, sometimes energy, depending on the last few days it hasn't been. So you want to rotate into more areas that are going to provide a little bit of a cushion against that downside. You can still stay invested, maybe lighten up your equity exposure a little bit, but certainly, I don't think you would recommend selling equities in general. Of course, the bond market usually provides a bit of a cushion. Can't say that with a lot of confidence considering bonds have not been the best hedge. They certainly did a good job in Q1 on some of the downside there, but that would be another spot to consider.
Okay, thank you.
Yeah, and keep in mind that most of our portfolios, I think Adam alluded to it earlier, but we do incorporate a lot of alternatives in order to
Oh, good. Yeah, good call.
provide that downside protection and diversification from the markets.
Okay.
I'm glad you mentioned that. Yeah, I kind of glossed over the alternatives. That's something we're building up in LPL Research as well, from a product standpoint, from a coverage standpoint. You'll hear us talk more about alternatives. We actually going back to that stack committee, we went overweight alternatives coming into the year because we were worried about volatility, and they do a nice job of diversifying your portfolio and providing a little extra cushion. When everyone else is zigging, they tend to zag. So it worked out well in Q1 for us.
Okay, great.
Agreed.
Is it okay to ask a second question?
Sure,
Yeah.
go ahead.
So obviously tariffs have had a huge effect. Are there any other potential changes that might tail on or tag on to the tariff issue that might cause another major upheaval, or is that just the huge unknown?
Depends on your time frame. The tariffs create volatility. Volatility can create obviously panic selling and do some pretty significant damage. And I think there's a cohort of strategists out there waiting for we'll call it a Lehman moment, or a long-term capital management type moment where you start to see a hedge fund blow up, something like that, where they basically have to shut the doors because they're offsides on a trade. We haven't seen that yet. I don't think you have to have that. Again, we use kind of weight of the evidence approach, right? Where we go through our list of items we want to see before we start thinking about a market bottom and kind of turning contrarian and looking at the upside. And throw that on the list of having one of those kind of Lehman moments on there, but it's not a requirement to have that checked, because if you wait for all of those items to get checked, you're going to miss the market low, and they tend to happen, or can happen pretty quickly. So again, going to that horseshoes analogy, I think close enough when we look at the evidence. And then, of course, we think a lot about the budget deficit in the U.S. and what we're going to do to address that. That's a problem that I think will be coming more and more mainstream. Of course, in light of the tariffs, it's bringing more attention to the deficit out of control. So there has to be something done in Washington on that, and it can be a painful process. Tariffs, as they were introduced, certainly help on the budget deficit. When you think about, maybe depends on what number you're using, but in the several hundreds of billions of dollars being added to the Treasury, that helps reduce that budget deficit. And then shorter term, I mentioned this thing called a basis trade. It's basically an arbitrage opportunity for hedge funds that will use a massive amount of leverage to capture a little bit of yield or a little bit of alpha between what's called the cash treasuries and the futures market. So there's a little bit of a gap there, and they'll leverage up and use that to capture that little bit of alpha. So if that basis trade starts to get unwound and the treasury market more or less seizes up, that's another one that started to percolate over the last few days with all the volatility in the treasury market. Tough to really make the case. That's, it's one of those you'll know with the benefit of hindsight. It's hard to make that call that it's going to happen, but certainly something to watch out for.
Okay. Well, thank you for answering those questions. That was helpful.
Thanks for the questions.
Sure.
All right, anybody else before we?
So I have a question. Of course, with the uncertainty of the market right now, my question is, do I keep investing like I normally do, like putting a little bit, quarterly or every month? Or should I just slow down a little bit on my investments and maybe diversify my portfolio and put money more into a CD or a T-bill or treasury bonds, those things that might yield a more stable return right now. I don't know. I'm saying, okay, will the market recover quickly enough? Should I put my money somewhere else? And of course, I'm a total ignorant in this whole field of investment. So it may be a silly question. I don't know.
No, that's definitely not a silly question. One that we get nonstop here in research. It's probably I don't know if you want me to answer that or not, just because it is client specific, not knowing your situation.
Well, to put some perspective, Adam, we are about 4 to 5 years, we hope, from retirement.
Yeah.
So that's why the question has a little bit of more meaning for us maybe than for longer term investors.
Right. And I think in general, just looking at equity market exposure, how much downside risk is in the market, and this isn't going to be the exact answer you're looking for. I think over the last few weeks, we have significantly de-risked in the market. We have priced in a lot of the bad news. And again, I think those lows that we witnessed in the last few sessions here were probably the lows we're going to see, and we'll start to work our way higher. Now, that doesn't mean there's other opportunities, but I think dollar cost averaging is always a good strategy throughout any type of environment. So in terms of continuing to invest, given your time horizon and not knowing all the details, I have to refrain from really getting any more specific, I think, at this point. But a good and valid question.
Okay.
And I think that what I would add to that is that during market volatility, you tend to be able to pick up some things, better better opportunities than you would when things are going really well,
Okay.
right? So more of your dollars possibly being able to get more shares
Okay.
at a lower price.
Right.
Okay.
Okay.
They historically, when you're down this much on a long-term basis, these have historically been buying opportunities and significant ones at that.
Okay. Okay. All right.
Thank you.
Thank you.
Thank
Uncomfortable,
you.
I know, to look at the market and the volatility, but I think doing this and being in the trading world for almost 10 years, I think the best trades and investments I've ever made is probably when I'm the most uncomfortable. Just to give you
That's
some
interesting.
perspective.
Yeah, that's when you were talking about Warren Buffett's, right? His
Exactly.
saying, be greedy when others are fearful.
Yeah,
Mhm.
easier said than done, but
It is.
the longer
It is.
term, you see these events, and like you said, there's pretty historic events we've seen in terms of price action here on the way down, and also today's rebound. I'm not suggesting we're going to rebound all the way to record highs at a 10% per day, but certainly constructive price action and some constructive or confirming evidence that we're seeing here that maybe the worst is behind us.
Sounds great.
Okay.
It's encouraging.
Yeah.
It's funny that we had the call scheduled for today, right? We didn't know that this
Yeah.
was going to happen.
Oh,
Timing is everything.
I've had both sides of this.
That's right, Heidi.
I did a client presentation Thursday night after the big sell-off, and then another one on Friday. Those were not as fun as this because we had no answers. There's a lot of depressed investors, I think, at least on a short-term basis in there. So it's nice to do one of these with a positive and a big rally day with some better news, of course.
okay.
Anybody else out there?
Well, chime in. You also want to look at the backdrop of if we get a lot of industry coming back to the US, what that's going to do for future growth, future productivity. Sometimes it takes the pain of change to really, fuel long-term growth.
Right. Yep. 100%. And I think that's one of the goals here for the White House is to bring that manufacturing back. And one of the key strategies behind this move. And we've seen a decent amount of what we call reshoring in terms of bringing that production back. Of course, that kind of started back in the 2016 campaign, and it's continued. There's the nearshoring where you have companies moving to Mexico, but certainly good for, I think, the overall health of the longer term health of the U.S. economy to have some of this back in America. We witnessed the pandemic and our risk of supply chains there with everything coming from China. That was a complete disaster. So having some stability in our supply chain with bringing manufacturing back to the U.S. was another added benefit here.
Last chance. Okay, I'm not seeing anybody raising their hand or, excuse me, unmuting. So thank you so much, Adam, for your time tonight, and great to see everybody out there. And excuse me. And you know where to find Adam, Heidi, and I if you have any questions at all at any time. We are here for you. Email, call, stop in. We're here. So thank you all. Have a great night.
Thank you. Have a
Thank
good night.
you.
Thank you, Adam.